In the risk management industry, there are 5 basic strategies to address a risk. Ignoring the risk is not one of them. Hey, welcome to the Retirement Answer Man Show. My name is Roger Whitney. I am your host, and this is the show dedicated to helping you not just survive retirement. We want you to rock retirement. I am personally hoping that my voice survives this show so we can dive into this very important topic. So in risk management, there are 5 strategies. Number 1 is you can retain the risk, which is self-insuring, just taking on all the consequences yourself. There's avoiding a risk. If you don't jump out of an airplane with a parachute, you don't risk the possibility of the parachute not opening. So it's easy to avoid that risk. Not really easy to avoid the potential of a long-term care event. So we can't avoid all risks. We can mitigate risks by taking intentional action to either lower the odds of the risk manifesting itself or lowering the severity of the risk if it does. We talked about some of those measures last week with Dr. Milstein. The last 2 strategies involve bringing in a third party, typically an insurance company, which is in the business of taking on other people's risks, either by sharing the risk with them or owning all of the risk. And that's what we're going to start to dive into. And this week, we're going to focus on traditional long-term care insurance. And then next week, we'll look at the hybrid policies. In addition, we'll get to some of your listener questions. But before any of that, let's have a word from our sponsor. Do I have enough to retire? When can I retire? How much can I spend in retirement? If you want answers to those questions and you want to be equipped to be able to answer them for yourself, I encourage you to check out the Rock Retirement Club. We have over 300 people in there rocking retirement that are doing retirement well. But I'm excited to announce that just last week, we launched the first module of Rock Retirement University, where I provide a step-by-step guide in teaching how do you go about answering these questions, giving you a tool to answer those questions along the way, and also giving you deep dive courses into the core topics that we're going to need to understand, whether it's Social Security, Medicare, portfolio management, building the bucket system. This is what we're building. We just launched the first module, so I'd be honored if you check out rockretirementclub.com.
Huh? What does that mean?
So let's continue to define long-term care insurance terms so we can understand when we're looking at these policies and illustrations for us. Today, I want to talk about lifetime maximum benefit, which is a term you're going to see if you ever look at a long-term care insurance policy. What does that mean? Well, it's actually pretty self-explanatory. It describes the pool of money that the insurance company is willing to take on for you. Now, we used to have policies that were unlimited lifetime benefits. Now you don't see those much anymore. Typically what you'll see is, okay, if you pay me a premium for X amount, I will give you a pool of money, say $400,000, that you're able to place claims against to cover your long-term care benefit. That's the deal a lot of insurance companies are giving. So once you tap that policy and submit a claim, it gets approved and they pay out that policy. That goes against, in this instance, your $400,000 benefit, as an example, your pool of money. And then as soon as you exhaust that pool, basically the insurance has done its job and is exhausted, and then 100% of the claims or exposure goes back to you. So when you see that lifetime maximum benefit, you're going to use that along with the other terms of the policy to evaluate whether the premium that you're paying justifies the transfer of risk that you're getting. So that's important to understand. With that, let's go to our main segment and dive into this topic of traditional long-term care insurance. So many of you already know my feelings on long-term care insurance, and this is one reason why I do these themes, is so I can re-examine them for myself, because I'm not the expert for sure. So what I thought I'd do is bring on an expert in long-term care insurance, and we have a great one. Steve Cain is a director and national sales and business development leader for LTCI Partners. They are the nation's largest long-term care insurance retail and wholesale brokerage enterprises. So basically what that means, what's a brokerage enterprise in the insurance business? It means they don't work for a insurance company. They are a brokerage of insurance companies. So they work with numerous insurance companies, and they work directly with corporations and corporate benefits, but also with individuals. And so when they're working with someone, they can find the right insurer for what they're trying to solve for. So they have a lot of different tools in their toolbox. And Steve has been a leader in this industry for a while, and he serves on the board of the CLTC and is the leader and chairman of the National Association of Health Underwriters, the LTC Insurance Working Group, and he regularly pens a lot of articles in the Wall Street Journal and Forbes and other places, and he addresses these issues in the regulatory environment, but also he's one that's really trying to make this industry work for the insurance companies, but also for those that need coverage like this. So let's have a conversation with Steve. And I basically interview him about and quiz him on the state of the long-term care insurance industry and premiums, because there's been issues there, how the policies work, and try to get a robust understanding of the industry so you and I can go be equipped to make better decisions. So let's have a conversation with Steve. So Steve, I appreciate you coming on the show to nerd out on long-term care insurance, because it's such a fun, entertaining subject, no doubt.
Exactly.
Well, hopefully we can make it that way and provide some knowledge so we can evaluate how we make these decisions about this.
Right.
So you ready?
I'm ready.
All right.
And I'll tell you what, it's a tough decision, deciding whether you want to plan using insurance or not. And it's one of these issues that people don't want to think about. So I appreciate everybody taking the time today.
Yeah. So we're taking this whole month to explore the issue. And I actually do this obviously because people are thinking about it. But for me, I reevaluate certain areas of how I practice by doing series like this. And my position on long-term care has been that, yes, it's a risk. Oftentimes it's overstated, but obviously if it happens, it can be devastating. But when you're looking at transferring the risk, that industry, your industry, so I want your perspective on this, is so much in its infancy in terms of the claims history that even if, and we've seen that, we can talk about that it's hard to commit dollars to transferring some of the risk because I don't know what the visibility is on how those premiums and the ability to pay the benefits are going to be. So give me your perspective on that, being an insider and dealing with this every day.
Yeah. Life insurance has been around forever. Disability insurance has been around a long time. Long-term care insurance has been around 35 years. And it is considered an accident and health insurance product. And I don't think any of those products have ever been priced just right, where you don't have to go in and make changes. So I agree with you as a consumer, of this type of coverage, and somebody who's actively in the middle of planning for myself and my wife with this coverage. You got to think long and hard about making a 20, 30, 40-year premium commitment when it comes to this coverage. So I get it. And yes, the industry's faced, a lot of challenges because it's immature compared to other lines of business. I do feel more confident, today than I have ever before. And I've been in this business for about 20 years. But I certainly understand somebody's apprehension as to which way do I go with this? Is that company going to be around when I need it?
Yeah. And I imagine, you like how I start with a real soft question.
Yeah.
By the way, I could have probably laid that up a little bit easier. The headline news is so-and-so insurance company raises their premium by 80%. We see some of those headlines. I guess the first question is, are those exceptions from the older policies, or is that sort of the rule of thumb that everybody is recalculating premiums on the older vintage of policies?
You know what? Nobody is immune from the pain that's been created by the first generation of long-term care. I would argue that we're now in second generation long-term care, and these companies, those remaining, have learned from their mistakes and other mistakes, but there were a number of pricing mistakes that were made when this stuff was first out there. And all of these companies are really hurting to correct some of the mistakes that they made. And unfortunately, the policyholder or the end consumer is feeling that pain in the form of rate increases. So, again, here's the nerd in me. There are a few ingredients of what makes a policy stable and what makes the rates, jump. Boy, they missed out on nearly every one of those points. So they thought more people were going to lapse the policies than actually have.
Which is give up a policy.
And that impacts. I think originally when these policies were priced, the insurance companies thought that 6 to 7% of people would just drop the policy like they do with life insurance or Medicare supplements. And we're finding that 1% of people drop the policy. And that's a significant impact on the profitability of those blocks of business. Also, I don't know that the insurance companies expected this many people to go on claim and go on claim as long. So the mortality and morbidity assumptions, were off. And then you factor in record low interest rates where they're thinking they'd get 6, 7% return on that money. And we know where 10-year treasuries are today. And so you add all that up, more people going on claim, less people dropping the policy, more people going on claim longer, and that led to a lot of pain for these insurance companies. So first generation long-term care, you're going to continue to see in-force rate increases. I'd like to think that today's long-term care is going to be much more rate stable, and these insurance companies have learned.
A lot of times we think of just claims history. As baby boomers are aging, that is the biggest factor. But you named two other really big factors in premium stability, which is people surrendering the policies. But a big one is interest rates, because that is really what insurance companies do. They take the money and they make the difference because they get the use of the premiums, right?
It's really interesting in terms of what the insurance companies can do with the money. By state statute, around 60% of all premium dollars that we give the insurance companies has to go to reserves to pay future claims. There's no exotic investments going on. These insurance companies have to put it into bond portfolios and take a look how bonds have been performing. It's been a confluence of factors that have led to all this pain, and it's not just claims. But on the positive side, what I will tell you is this stuff works. Yes, there have been and there will continue to be in-force rate increases on all the old stuff. But in 2019, insurance companies paid over $11 billion with a B in claims. And the claims satisfaction rate, when families are surveyed, when even claimants are asked, like, how's the process? They say it's been fair. It's worked. It did what we thought it was going to do.
Yeah, and I think that's the key. And that's one reason why the flip side of a premium increase is it sure hurts, but you want the insurance company to be viable to be able to deliver. And they have to do that in order to make everything work.
Yeah, we've seen carriers, like, as a policyholder, it's painful to get a rate increase. You don't like it. But as a shareholder of a publicly traded company, which many of these are, the shareholders don't like it because what happens is these companies take charges and they go out and take $500 million, $800 million, $1 billion and move them into reserves to pay future claims. So I applaud the industry for taking those steps to make sure that the person who bought coverage 20 years ago, they're going to have benefits. They're going to have money, the insurance company is going to have money to pay those benefits.
I want to go on to talking about the levers we have as a consumer when we're evaluating a traditional long-term care policy. But before I do that, I have a quick question. I mean, it's for real when we see what happened in 2008 of, okay, I'm going with insurance company XY for my insurance policy.
Right.
What happens if XY goes away 10 years from now? If I'm a consumer and I own a policy with this particular company, do they basically default on their promise? Or in real, I mean, I guess theoretically they could, but in reality, what typically happens when a company is dealing with that to the policyholders?
Yeah. We've got a couple examples of insolvencies right now. The kind of second tier companies that were very liberal underwriters medically of this coverage and got themselves into a lot of that claims pain, have gone through it. But right now there's something called the State Guarantee Fund, and it's basically insurance on insurance companies that each admitted insurer has to pay a premium such that if one of their brothers and sisters becomes insolvent, then policyholders, and it varies from state to state, but in most cases, policyholders have up to $250,000 worth of benefit. Might vary. There might be a state that has 225, 200, but usually it's about a $200,000 pool of benefits that's available.
How many actually would access that, or is it more common to be absorbed into healthier players, or generally they don't want to touch it?
Yeah, I mean, we're just starting to see a couple companies go through that right now. Those companies, there might be an exposure of about 30,000 individuals right now with one of those companies that have that policy. It went into receivership and the State Guarantee Fund is kicking in. I will tell you that the life insurance industry is not happy about this, and they're griping about, hey, why do I have to pay for this if I never was even in this business? But I think there's going to be continued dialogue amongst insurance companies and the state regulators. But I like the fact that there's a safety net. And I will tell you also that as a consultant, pre-recession, and I'm sure you could cross business lines, and when you look at companies too, you just say, well, their AM Best rating is strong. Yeah, it's a big brand name. They're going to be okay. And I'll tell you what, post-recession, that changed everything for us. Yeah, I could look at somebody's brand and their financial rating, but what does that really mean? Now, as we visit with carrier partners and we're analyzing their product, it's not just about the pricing, because the pricing could be what it is today, but I'm concerned, like, what's it going to be for that 50-year-old 20 years from now? So when we analyze products, we look at how's their underwriting. Are they tough underwriters? That's okay. I want to make sure they're not taking on bad risk. What's their interest rate assumption on the product? Are they pricing in mistakes? In case, they have adverse selection. We're looking at that. What's their lapse rate assumption? And most products today assume that only 1% of people accurately are going to lapse coverage. So that's the kind of thing that we look at in the background before we even enter agreements to sell a carrier's product.
Okay, so let's dive into traditional long-term care. And let me just ask some questions and you can tell me, because I am by no means an expert. If you go through and get a traditional long-term care policy, you're going to go through, we'll start there with underwriting. So underwriting is basically the insurance company evaluating the risk that they're taking, right? So what does that involve?
They want to make sure that you're not claim eligible today or anytime soon, right? They're going to want to make sure that you pay in a number of years of premium before you actually go on claim. You got to think about it differently than most people understand life insurance conceptually, that I die, my beneficiaries get money, right? And with life insurance, it's a mortality risk. Are you going to die? With long-term care insurance, it's a morbidity risk. Are you going to live with chronic ailments? Are you going to live with something that is going to require care at home or assisted living or in a skilled nursing facility? So you got to look at it a little bit differently, and the insurance companies do. There's not a blood work or a physical like life insurance. The insurance company will, in the background, do a prescription drug screen, see what kind of medications and dosage and what you're refilling. They will do what's called a Medical Information Bureau check, MIB, to make sure that you weren't declined by a company a week ago or a year ago. And then there's an application that might be lengthy, might be 3, 4, 5, 6 pages worth of questions medically. They'll do a phone interview, an application, and in most cases, they'll go out and look at medical records from your primary physician from the last 3 to 5 years. Having said all that, about 80% of people who apply for coverage get coverage.
Is the coverage ranked like, standard, premium? How do they rank people that way and adjust the premium?
There's not the type of variability in terms of health classes like life insurance. Oftentimes there's table ratings and preferred, super preferred, and then below that. With long-term care, it's usually a preferred being the best, a standard, and then a decline. And there's not even tremendous variability between companies. Usually a condition that would have you as a decline with one company, you'd probably get declined by the next company.
Yeah. Whereas in life insurance, a lot of times, they'll underwrite differently. So they'll
underwrite differently. With life insurance, they might say philosophically, we as an insurance company look at this condition differently.
Okay.
And here's why. With long-term care, it's pretty standard. And, there was just some industry reports that came out that showed, obviously, the decline rates increase by age, right? We're never as healthy as we are versus today. But really, if you've got somebody applying in their 50s and 60s, which is when this is on the radar screen for most of us, about 80% is the approval rate.
Okay. Let's go into some of the options. So if I'm looking at a long-term care policy, how do you craft a policy? What are the levers I have in terms of, let's just go through those.
Once you've determined that this is something you want to do, that it makes sense for you, in terms of like, how do I structure the policy? I try to keep it simple. Whatever policy you're looking at, there are really 3 decision points that you as a consumer have to make to design coverage. I don't care which insurance company you're talking about. There are 3 things that you need to do to design a policy. And number 1 is just the how much. How much do I want the insurance company to pay me when I need the care?
So another way of saying that is how much risk do I want to transfer?
That's it. How much risk do I want to transfer? A lot of times these decisions, the catalyst for planning is a personal experience. So you have a mom or dad who just went through it. It's fresh. You know that it cost X amount. So a lot of times people start there. Some people don't have personal experience and they're just looking at their financials and say, okay, I know ballpark the cost of this care is going to be this. Let's hedge against this risk and let's design a plan that covers 70% of my long-term care risk. But really, fundamentally, the first factor or the first design parameter is how much do I want to get reimbursed or paid when I need long-term care services.
And so how do we define that? So what's a typical amount?
I think we as an industry really screwed up years ago where we tried to design plans for perfection. And we would look at these average costs of care or cost of care for an area, and we try to build a plan for exactly that. Now I see so much difference in terms of the plan design. I see more hedging, and I see more people co-insuring where they might buy some insurance and take on some of the risks themselves. But nationally, our average at our firm is about $150 a day or $4,500 a month of benefit. And that'll cover the lion's share of somebody's long-term care needs.
So $100 a day.
$150 a day or $4,500 a month.
Okay. And do they think of it as a daily rate, or is it how much?
Most times it's a monthly.
Okay.
Most time it's a monthly because your daily costs might fluctuate depending on what type of care you might need at home. The second design component, hey, how much do I want? How much coverage? How long do I want this thing to last? And so essentially what you're doing is you're buying a pool of dollars that you can dip into, or if you want to think about it like a checkbook for your coverage, and that determines how much coverage you have available in that pool of dollars. And so you can dip into it at $4,500 a month as needed, and it'll last however long you start that pool out as.
You're basically buying a bucket of money, and then whether it's unlimited, whether it's 300,000, 400,000, whatever the number is. And then you're also defining how much you're allowed to tap that bucket on a monthly basis. So those are 2 different levels.
You got it. So what you're doing with the first component that I mentioned is that's the cap. You can't go over, I selected $150 a day or $4,500 a month. I can't dip into that pool of dollars more than $4,500. But if it's less, let's say, for example, it's unskilled care at your home, it might be $3,000 that month. That remaining amount stays in the pool of dollars.
Okay. That's one big lever is how much of the pool do you want, unlimited or 300,000 capped, and then how much you tap a month. Is there a logic as to whether you go up and down and how much you could tap a month in terms of policy cost?
It just comes down to like what fits into somebody's budget. Right? Like when we have conversations with people about long-term care planning, particularly those who have had personal experience, they get it. And once we've talked to them about, the companies like we did and their viability and the long-term viability of these companies, it then just comes down to what can I afford? I've got competing financial interests. I'm at this stage in my life where I've probably got kids in college are still on the payroll. This makes sense, but do I have discretionary dollars to put away? And that's where we've seen more hedging strategies or people kind of co-insuring against the risk.
So generally what they're doing, they're starting, so most people will approach it from, this is roughly what I think I can afford a year. What can I get for it? Rather than building from the ground up.
Yeah, that's right. And in our nerd language, we call it solving for the premium. Here's the budget. Let's go build as much coverage as we can for that budget amount.
Okay, so the amount per day and the pool are going to be two levers to control.
And then the third one, which is particularly important for your listeners, these folks in their 50s, is the growth rate. Is this policy going to be worth something when I need it?
Define growth rate.
They've built in inflation protection components to these policies, and it's going to vary from company to company in terms of what types of inflation protection options are. But I would highly recommend it to somebody in their 50s and early 60s who are probably not going to go on claim until their 80s. We need to make sure that the value of the policy grows over time. So we've seen 3% compounded, 3%, 5% compounded. We have flexibility in terms of what types of inflation options that are out there. But typically industry-wide, we're seeing more of the 3% compounded being the norm. With the rule of 72, that means your benefits are going to double around every 24 years.
Okay. Is it common to think of take a lower benefit today to get more compounding if you had to choose between the two?
Yeah. Interesting in terms of the plan design conversations. It's like part art, part science. I don't know when you're going to go on claim.
It's a lot more art, I think, than science because we don't know.
I just don't know. I had a client last week that I'm helping through a claim who's got cancer, and he's a young guy. He's 60 years old, and he's going to receive benefit. If we went the route where we would have lowered the monthly benefit and added on the inflation, that might have hurt him from a claims perspective. So in that scenario, just by luck, he selected something that was in line with the average cost of care today, plus he added on inflation, and it's going to work out for him. But it's art. It really comes down to, I think inflation is really important. I think you've got to have something on there that grows your money over time. The monthly benefit is where we kind of go back and forth as to what can you afford? Are you okay self-insuring some of it? Those are the kind of conversations we're having.
That daily benefit, are there different definitions as to whether it's in a facility, home care, or is it just a daily benefit for anything typically?
The industry started out as skilled nursing care only, and then the delivery of care changed. And now, when I talk to insurance companies, between 60 and 70% of all of their claims start at home and end at home. So these policies, in the contractual language of these policies, it includes home health care, assisted living, adult daycare, skilled nursing, and even hospice care. And those are comprehensive policies, and those are what are on the market today.
Okay.
But what we're finding is that you and me, I can't imagine going into a facility. God forbid I need this stuff. I'm going to be at home as long as I can stay at home.
That's generally what people, I imagine, express. And then the majority of care is typically done by a relative. And I'm assuming that doesn't get covered by policies.
Depends what policy and what feature, and really that's where we come in as a consultant to sift through the different carriers, products, contracts to determine, number one, what's important to you. Is having a relative or family member important to you? If so, we take the conversation a different way from a product perspective. But by and large, most of these traditional long-term care plans cover a professional home health care agency or somebody that's licensed as a home health care aide.
Okay. And then another factor would be the elimination period. Can you describe what that is and tell me if that's really a big factor in planning to premium?
Used to be a bigger factor than it is today. The elimination period, and forgive us as an industry, we use all this crazy jargon. Nobody understands it. The elimination period is a deductible period. And that means how long do I have to self-insure before benefits kick in? And the insurance companies give us a whole bunch of options. But when I look at industry data, about 90% of everything sold in the industry has a 90-day deductible period.
The person has to pay for the first 90 days, then you can go. to the...
That's correct. Like, you're receiving services and care wherever it may be, and you're paying for the first 90 days, and then the coverage kicks in. And that kind of jives with Medicare. If you qualify for Medicare long-term care benefits, Medicare will pay for the first 100 days. So if you're lucky, you have that. If not, you self-insure for 90 days, and then benefits kick in.
Okay. And then the last thing I want to ask about some of this policy wonky stuff is how important are definitions in terms of what is something that will kick a policy in and what is, does that vary?
Yeah, it's a really insightful question. And I understand, like, as a consumer, where it's coming from, because we're conditioned to think about health insurance where I have a condition or a concern. I just had one personally with a loved one where our physician said this and the insurance company said, no, we're not going to cover that, and here's why. We don't think so. And with long-term care, not only is there standardized language that the National Association of Insurance Commissioners set forth to have product, but it's black and white. If you're unable to perform 2 of your 6 activities of daily living, or you have a severe cognitive impairment, then you trigger benefits. And so in each contract itself, it defines what home health care is, what assisted living, what skilled nursing, all that stuff. And then it also clearly defines in terms of what those activities of daily living are, and you need to be unable to perform 2 of them. And so what I've found is that it's pretty black and white. There's not a lot of second opinions when it comes to me not being able to bathe myself or dress myself without assistance, and certainly not with cognitive impairments.
Okay. And it's good to know if they vary. I pay the money and I have to go get the money, or they pay directly to the provider.
Either way. Yeah, either way. You could set it up such that...
So that's an option,
an
right?
Agency. Yeah. The other thing that I want to mention that I think, like, sometimes we as an industry haven't talked enough about, I look at the long-term care insurance 2 ways. Number one, it's something that's going to pay me to pay for my extended health care, right? It's a financial tool to, provide a tax-free funding strategy to pay for extended health care. But the other side of it is, and this is included in all of these policies, is a care coordination benefit. It's not like a gatekeeper or an HMO where you can only use certain services, but these companies have subcontracted out to third-party geriatric care companies where they will get on the phone with you and your loved ones and help you find the right home health care agency, maybe negotiate discounts on your behalf, and make sure that you're receiving the type of care that you need on an ongoing period of time. And that's just built into the policy, and we don't talk about it enough. And I went through a scenario recently with Mom. It was one of those slap you in the face moments where I've been distributing the insurance and as a consultant in the industry for 20 years, but when it came to the delivery of care, I didn't have a clue. I didn't know what questions to ask these home health care agencies. And boy, would I have liked some guidance in this process, and that's included in today's policies.
You're sounding like a lot of these things are much more standardized than they used to be.
That is. I think we as an industry have evolved, adapted. Not only is there standardization in the contractual language, but in also in the benefits that are offered and covered in these policies.
Okay. In your experience, and maybe you have data, maybe you don't, what percentage of policies actually have claims?
That's a really good question. The carriers are tight-lipped about, their claims experience, but again, you can call me a ninja or nerdball, whatever you want to call me. I've reached out to my friends that are actuaries, the folks that price these policies, and I say, hey, when you price a policy, what's your assumption in terms of how many people are going to go on claim? For males, it's going to be different than females, but when they price policies today, they think maybe 20% of people that are male are going to go on claim, and it's in the 30 to 40% range with women. Do I have a great answer? No, they're tight-lipped about all of the claims experience. I just look to my own life, and you look to yours in terms of people that have needed some help. Here's the good news. I went to the gym this morning. I had oatmeal, trying to lower that cholesterol. I'm going to live a long life, but I'm probably going to need some help. I don't know if it's going to be for 6 months or 6 years. If it makes sense to somebody to plan with insurance, then I feel much more confident today planning with it than I did 10 years ago.
The follow-on question on that would be 20 to 30% of people that have policies, let's use that as the number, are going to make a claim at some point.
Right.
I think the important next question is, and I'm guessing you may not have the data, to what extent, right?
That data we do have, a number of consulting firms and have come out with studies as to what's the overall exposure. If somebody needs long-term care, what's the cost? It's in the $150,000 range.
As average?
PricewaterhouseCoopers came out with a study recently that I can give you a link to that showed, that's what the cost. Now, by and large, most of those are short-term duration claims, and it's not that $150,000 number. But on average, because of the longer-term ones, somebody that has spent $1 million because of Alzheimer's or dementia, that kind of inflates the number.
Yeah, so you're going to have a huge range there, and then you have to get to how many are those. I'll call them outliers. That's sort of the calculation we're trying to do here, right? It's no different than if we weren't required to have, say, homeowners insurance in case of a fire. It'd be interesting to see the calculus of how many people actually bought it, because statistically, it's out there that it's going to happen. It's just the problem is the severity is enormous.
It's just so hard. Like we have so many conscious and unconscious biases as it relates to this type of planning. And that's why I commend you for having this conversation, because nobody wants to talk about this stuff. I was happy to see, forget about your political persuasion, but several of the Democratic candidates have talked about long-term care on the stump during a debate. Amy Klobuchar has been very visible in talking about long-term care. We've got a lot of fish to fry as it relates to healthcare in our country, but I think a lot of the leadership out there, a lot of legislators are thinking about, what are we going to do? We know this boomer population is really going to impact Medicare. How are we going to handle this?
Yeah, I think in terms of even planners, we don't want to talk about a lot because we don't know the answer. It's a hard decision. And so we go through all this calculation. We get a policy to a premium we can afford. And then I don't know what an average premium is for a policy. Is there just a rough?
Yeah, industry-wide at around $2,200 per person.
Okay, $2,200 per person. And if you're married, sometimes you can combine those so you have a joint pool, which gives you some help. So if it's $2,200 a year, and then I'm 55, let's say, I actually need to do one on me. I'll do that in the Rock Retirement Club. Can you help me get an illustration so I can?
Yeah, you'll be the guinea pig.
I'll be the guinea pig. And then I can afford, let's say, $2,200 a year. The next thing is we're just going to have some, I don't even know how to handicap the viability that it stays at $2,200 a year.
I tell people it's going to go up. I mean, you're talking about continuous premiums, right? So you're going to pay that $2,200, but if everybody in the state that you're a resident of gets a rate increase, you're subject to that increase as well. Now, I don't think we're going to see the double-digit increases, the 50, 60, 70% increases that we saw with first-generation long-term care. But these carriers are going to audit their blocks of business and make adjustments. So I'm a full transparency guy. I tell somebody that's 55 years old today that buys coverage, you're going to get a rate increase. I'm not sure what it's going to be, so let's factor into your budgeting about a 1 to 2% increase every year. Now, again, you're not going to see it.
It'll just happen in steps.
In your head, you have it. So if XYZ insurance company comes back in year 10 and you get a 20% rate increase, you're okay.
Which is no different than any other kind of insurance. I think of homeowner insurance here in Texas. I remember back in, was it the 90s? This makes me feel old now, where we had this mold crisis. And I remember seeing my homeowner's insurance go up by, I think it was about 80%. And it was that insurance company that had a lot of claims, and I ended up switching to a different insurance company that just entered Texas because they didn't have that claims history. But I imagine the difference there is it's going to be a lot harder to switch policies when you're 79, or right? You're going to have to stick with your carrier pretty much.
That's right. And again, even folks that are faced with these enforced rate increases, most of them are just hanging on to the policy at the increased rate. But we have seen a trend where the insurance companies have done a much better job giving policyholders options to dial down benefits to keep the premium the same. And ultimately, less than 5% of people drop these policies after a rate increase.
Well, Steve, I appreciate you diving into traditional long-term care. Next week, we get to dive into hybrid.
Thanks a lot.
So as you can see, my voice was fine when I was talking with Steve. Hopefully it'll come back here soon. Next week, he and I are going to dive into the hybrid policies. But for now, let's go answer some of your listener questions. We love answering your questions. I'm so glad that we brought this back to the show. Nicole is exhausted, so she's not joining us today. She and the entire team worked hard on Rock Retirement University, so she's getting the week off for that. So if you have a question, maybe it's something on a show that we're doing, maybe it's something that you've just been wondering about and you haven't had a chance to find a safe place to get it answered, you can go to rogerwhitney.com/Ask Roger, and you can leave us a wonderful voicemail or an email, and we'll try to answer it on the show. Our first question comes from David in regards to tax diversification.
Hi, Roger. This is David from Oregon. I'm a big fan of the show and look forward to it each week. My question is around tax diversification in retirement. I'm currently 55 and I'm married and plan to retire in 10 years. Right now, the vast majority of my savings is in pre-tax accounts. My company does offer a Roth 401k option, but here's my concern. My wife and I are currently in a 22% tax bracket, but based on our estimated retirement budget, we'll be in a considerably lower tax bracket in retirement. So under those circumstances, does it make sense to start contributing to the Roth 401k, or should I continue to maximize the traditional now to save on the taxes and use other strategies like after-tax savings in a brokerage account, backdoor Roths, or Roth conversions when I'm in pre-retirement or in a lower tax bracket? Anyway, thanks for the great work and keep it up.
Hey, David, that's a great question. As with almost all these questions, not with easy answers. So you're 10 years from retirement, you're 55, and your current estimated retirement budget indicates you'll probably be in a lower tax bracket later on because you're in the 22% tax bracket right now. So obviously I'm not going to have a direct answer. I don't know the answer to your question because we're dealing with so much information, but hopefully we can build a little framework for you and others to find an answer that makes sense for them. So the first thing is it's not really that clear cut. So if we look out 10 years, a couple things we don't know. What will the tax rate be 10 years from now? The 22% bracket is actually a very attractive bracket historically. We don't know where the brackets will be 10 years from now, which will ultimately tell us what was the best decision today. And that's what, part of the struggle we have to deal with is we're trying to forecast these things over a very long period of time. We don't know whether in a few years we're going to revert back in 2025 to the old tax brackets, or whether we're going to have new tax policy come out in the next 10 years that alters the landscape altogether. The other thing we don't know is what will the income ranges within each tax bracket will be. We don't know what those will be. So the 22% bracket, the next one above that's the 24, there's a range of incomes until you pop up. We tend to focus on the rate, but another lever that the IRS has is, our government has, is changing the range of brackets. So how quickly you move up those brackets. We have to, have some comfort that we'll be okay there 10 years from now as well. We don't know what RMD rules will be. We just got a 2-year extension to age 72. We don't know what RMD rules will be in 10 years from now. We also don't know what the taxation rules will be on Social Security, whether those IRA distributions and the tax rates, if your Social Security benefits become taxable, whether that's going to be at the same rate or a higher rate. All of these things are unknowns that make this decision a really difficult one. The other thing we don't know, David, is your estimated retirement budget. What will David and your wife spend 10 years from now? That's pretty far off in the future. Hopefully you're factoring in inflation, you're factoring in taxes for the amounts that you'll be drawing out of your 401k to cover your living expenses, because that's going to increase the amount that you have to take out. And hopefully you're factoring in what I normally see is people earlier in retirement wanting to spend more in terms of go-go years for travel or bigger purchases just after retirement because they're re-nesting and buying that RV or buying that second house. So those type of things can change that a little bit. And you are correct. You have about a 7-year window theoretically to be in a low tax bracket to do Roth conversions. I also don't know if you have other assets where you're taking money out to cover your income. So you're going to want to factor those things in there. But before you go and switch your 401k to the Roth strategy, I definitely think you should start doing some of the things that you mentioned or consider doing them. One is take advantage of the backdoor Roth if you can. That's, between you and your wife, assuming you're over 50, you can do $7,000 each into a backdoor Roth contribution. So that may tap your excess savings right there. If you can do pre-tax 401k and then do your max with the catch-up on your Roth, that's an extra $14,000 that's going into that tax-free bucket. I do like saving after tax. That's something that I started a while ago. I'm glad that I did it, even though I'm paying the tax on the front end. I've taken all the policy risk out of the equation as best I can imagine. One thing that you didn't mention that you could consider, and this is something I switched to recently, is I switched to a traditional high deductible policy for health insurance, really just so I can do an HSA and make the maximum contribution to an HSA. If you recall with an HSA, if you make the contribution to the HSA, that is tax deductible on the front end. If it's a family HSA, there's $7,100 a year you can get into that. And if you're over 55, you can do an extra $1,000 as a catch-up. So you get tax deduction on the way in. It will grow tax-free if you take it out for medical expenses. And most people that I see usually will tap that money as they have medical expenses. But if you have the cash flow, it can be really powerful to put in that $7,000 or $8,000, invest it like it's a super duper Roth, and just pay all your medical expenses out of pocket. Keep the receipts, because right now there's no statute of limitations on when you can submit those receipts. Now you have $14,000 a year for you and your spouse in a Roth or a backdoor Roth if you go through that procedure. Then you could have another $7,000 into the HSA that you could treat as tax-free all the way around. And then you could save after tax. So I think those are the easy pickings to do before you necessarily start the Roth 401k if you really value that deduction. So hopefully that gives you some things to consider as you make this decision. There is no exact right answer. I'm in a higher tax bracket than you, and I'm doing a lot of these things that I just mentioned for exactly the same reason. So hopefully that helps you, David. Now, our next question comes from Ed in regards to sequence of return risk. So Ed's question, and he basically gives me some assumptions. He said, okay, Roger, I got $1 million in a 401k. I have a 5-year bond ladder, it's $32,000 per rung. I'm only removing money to replace used rungs of bond ladder in years where the 401k moves in a positive direction. How effective is this in removing sequence of return risk? How does it improve my chances of success staying out of the retirement trailer? Okay, Ed. So there's a lot of information I don't know here, but let's talk through this. So you have $1 million, you have 5 years of $32,000. It's about $160,000. So would the rest of the portfolio be 100% stocks? If so, your portfolio is going to be 84% stocks and 16% bonds. What you didn't give me here was your withdrawals from this money. So is the $32,000 in this 5-year bond ladder when a bond matures? Are you taking the money out? Is that your living expense from the 401k, that $32,000 a year? If so, we're looking at about a 3.2% withdrawal rate. So you're likely totally fine. If not, the whole point of sequence of returns, and this is the important part, is drawing big money out or drawing money out during really bad years. So if you're drawing out the $32,000, then you've basically built yourself a 5-year income floor, and then you would strategically refill it with the 100% stock portfolio. And I'm just inferring some of this. And the odds of you having enough up years to be able to refund it, a good example is last year. If you made sure that you refund all of the 5 years, if you fell behind 2 or 3 years, at a 3.2% withdrawal rate, you likely would be okay. Now, we didn't talk about, this $32,000 $1,000 a year bond ladder, whether are we increasing that for inflation because this is your spending account? So we don't have enough information here, I think, to really answer the question robustly. But the point is, with this sequence of return risk, is isolating the amount of money that we're going to need in the near term so we can in turn isolate the money that we can allow to be at risk. And this goes back to the pie cake discussion we had at the end of last month of we want to segment the money. I have no problem doing bond ladders in the way that you're talking about. The question is, what is the risk of the rest of the portfolio? If it's 100% stock, is that because you feel it needs to be, or because it's just a theoretical example? I think the pie cake and the time segmentation of allocating our assets is essential in retirement, because that's going to allow us to not be too hot or too cold in risk and set each layer up for success. So hopefully that helps answer your question, Ed. You're welcome to email me back if I totally misunderstood based on the information I gave. But I think that's the key with sequence of return risk. We got to be aware of it. And really, we just have to plan for it robustly as we can, because ultimately what we're trying to do is create that retirement paycheck that we all want and need so we can rock retirement. So I'll answer more of your questions next week. But for now, let's get on to this week's Smart Sprint.
On your marks, get set.
And we're off to set a little baby step we can take in the next 7 days to rock retirement. Take that little baby step. So in the next 7 days, I want you to evaluate these 5 strategies: retain it, avoid it, mitigate it, share or transfer your long-term care risk. Let's evaluate what kind of exposure you have. And if you're really motivated, go and get a quote from a qualified insurance broker or agent on long-term care, just so you can start to understand the mechanics of it. I'm not saying go get the quote so you go buy something. I'm saying get the quote so you can see a framework of what they're willing to cover, and you can start to think more proactively about it. I would prefer that you decide to retain the risk, but you made that decision intentionally, than to not address it at all. Well, Nicole is going to join us next week. I'm excited about that, and hopefully my voice will as well. So remember, this is all helpful hints and education. Don't take advice from me. I only give advice to clients I work for as a fiduciary, and talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense, my friend.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.